executive leadership, industry newsmakers, top producer insights. This is NFM TV.
Welcome into NFM TV. I'm your host, Greg Sher. We've closed out the month of April. We're now into May, and I'm often asked this question, especially lately the last couple of weeks: how is David Silverman doing? I'm asked that a handful of times a day by people at NFM Lending, by other friends and colleagues in the industry. So I figured rather than come up with the answer myself, I would go right to David Silverman. So joining us now is the CEO and founder of this great company that's been in business now 22 years. Dave, you've seen quite a few things in that period of time. And here we are in this moment. So answer the question, how are you doing?
I'm doing great. I appreciate you asking me. I actually had the virus back in early March, and fortunately I didn't have it to the point where it was completely debilitating, and I got past it pretty quickly in a couple of weeks. So I feel really good. I have the antibody, and I've been able to work every day, so I'm grateful.
So you had coronavirus. This is breaking news. And so is it the kind of thing where you felt sick, went and got checked out, or the kind of thing where you got through an illness and then after the fact went and got tested?
Yeah, so I actually made the attempt to get tested. I was feeling bad, fever, all that stuff for a while. And then finally, when it looked like you could get tested, I went to the hospital. They basically didn't let me in, said that, I didn't have enough of the symptoms. So they just shooed me away. And then about 3 weeks after that, the whole family got tested. We had somebody come to the house, do the actual testing, and then draw blood to do the antibody testing. And everybody came back negative. I came back negative for the virus, positive for the antibody. Said I had it about 3 weeks ago, which made perfect sense to me.
Well, I'm glad you're doing better. Now let's get to this seismic earthquake that has been reverberating around the mortgage business. Take us through that period in time where rates dropped precipitously, unexpectedly, margin calls were pervasive around the business. What was that like for you and for the company to have to go through that?
So this is, as everybody that's in the industry knows, what a tale of two cities the beginning of 2020 has been. We rolled into 2020, super low rates, probably best January and February that most companies have experienced, most originators have experienced, either ever or in years. Depending on your geography, right? And then so we're rolling in with these giant pipelines, super low rates, and then boom, the virus comes. And then we go into instant triage because so many things happen so quickly. And yes, we can draw, on our experience of 2008, but this was entirely different. Particularly, like you mentioned, the margin calls hit a lot of companies very, very quick and at a level that we had never seen before. In the last 8 or 10 years, I don't think the largest margin call we ever saw was, a couple $100,000, and companies were getting 10, 20, 50, $500 million margin calls, depending on the size of your company.
So has that slowed down, and do you expect that to pick back up, or do you think it's normalized?
Well, so the margin call, I think people got past the initial issue that put out on there, because it was not just the margin calls. It was also, loans that you had in your pipeline. If you closed and funded them, you were then going to sell them at a heavily discounted number. And again, that didn't affect the average originator. The average originator, I would say 99% of originators were paid as normal, as they should be. But the companies took that on the chin. So a lot of companies, NFM was no different, were faced with, closing record volumes and doing it for less than zero. Paying everyone, and then of course, scrambling to make sure you have enough cash because margin calls are coming out on the other side of this. So it was a very challenging couple of weeks. And as I look back, and as I will continue to look back over time, there will be a lot of blessings that come out of this because we've learned a lot. We've made a lot of adjustments that are going to help us going forward. And I hope this video and some of the information that comes out of it will help other people realize some of the changes that they can or could be making during this time.
Yeah, we'll get into that in a minute, but in this little gap between the business moving forward and the moment we're in right now, I just want to touch on some of the things that are headline related. We'll start with the efforts made by the FHFA and the director, Mark Calabria. He's come to the rescue to some extent, not as much as some would have hoped. What's your opinion on what the government has done in response to being there for the mortgage business?
So I'm sensitive to all the sides in this scenario. Obviously, I'm biased as a privately held mortgage bank, but the FHFA, they're overseeing Fannie and Freddie, and they're just inches away from coming out of a long receivership period, and now boom, this could really set them all way back. So on what I understand on that side of it, and that has been like the big bumping between the NBA and all of us on this side, and all of what we expect the FHFA to be able to do with their power. So look, I think they're doing the best they can. I'm sure many of us would like to see them do a little bit more and be a little more lenient on some of the things that are available to them. But I also understand that they want to make sure that companies like NFM or the big servicers or wherever are big boys and girls, and that can withstand some blows and remain standing and keep heavy balance sheets and be responsible. Because in the end, this is I keep harkening back to 2008, but we are returning to the age of responsible lending. Not that it's been irresponsible for the last 12 or so years, because it's been anything but that. But the mindset of the average originator is probably not really cared that much about responsible lending, because all of the guidelines have already been there for the most part, and they've just been loosening. And now all of a sudden, for the first time in many people in the industry's careers, they're seeing a tightening, and it's very rapid.
What would you say to the originators out there, some of whom have never seen any moment like this, with so many things changing every day? What would be your advice to them?
We have gone back and looked at, I wouldn't say the exact playbook of 2008, but one thing, and I've mentioned this before, responsible lending. And whether you're an originator or whether you are running a mortgage bank, there's just one simple question that I always feel like brings me right back to the center, which is, would I lend my own money to this borrower? And if the answer is no, you can begin to wonder why. You can begin to understand why some of these changes have been made. Why are all of a sudden people not doing 620 or 640 and below scores on government loans? Why are they raising the parameters on cash out? These are the things that, if you don't see 7 dominoes ahead, the first domino falls and people are like, okay, well, that was interesting, a domino fell. But inevitably, there's going to be 7 dominoes that fall. And if you don't make the moves now, you're going to get clobbered being underneath some of those dominoes. And so many companies made early moves and said, oh, we're going to cut off refinances with this particular score level, or we're going to make this adjustment, or we're going to have this overlay. And it hasn't been popular for the origination world out there, I can tell you for sure. And they're always comparing, hey, company A does this and company B does that, and why are we doing this and why can't we do that? And I understand that, I totally do. But at the end of the day, it comes down to trying to be ahead of those dominoes. And you can either be overly conservative or you can be overly aggressive in this market, and who knows who's going to be the right one on the way out. But if you're a boots on the ground relationship type of originator that's also now taking advantage of the refinance market, like all of our originators are, they have been hit with a lot of changes very quickly, and not just at NFM, I mean across the entire industry. And what I would say to them is, these are very bright, very aggressive, great salespeople that are out there. And if they just take a deep breath and understand that they are blessed to be in one of the industries that has been able to work through this entire pandemic, and that, making these adjustments is a small price to pay. Because at the end, there's still plenty of great loan product, particularly if you're at a company that is direct to all 3 tickets. So yes, is it suck to all of a sudden have a loan and a borrower that you really want to care for and do this loan for them, and now all of a sudden it's not available, or it's priced out, or it's just nobody's buying that product? Yes, of course it is. But thank goodness there are other products that you can sell. So I would say to them, I am empathetic of their situation. Believe me, it is not easy to take these changes and not know what's coming next. But I'd say to them, there's so much great opportunity with what you have left, and that things are getting better every day.
David, one thing that has been very obvious is there is a shift in terms of servicers being in the marketplace and companies focusing more of their energies and efforts into going direct. Fortunately for you in NFM Lending, you've got the Ginnie Mae ticket. Just talk about the change that you're seeing in the landscape as it relates to agencies, and if you think this is here to last.
Yeah, so we are very fortunate that we're in a very small group of companies that are direct to Ginnie. And I think there's less than 80, maybe seller servicers, many more on the Fannie Freddie side, which we have those tickets as well. And there are times in this business, and we've been around for 22 years, so there are times when, the brokers have the hot hand or the correspondent has the hot hand. But ultimately, I've seen a couple of times in this industry where having that ultimate, independence of being able to make those decisions and sell direct, it can really make all the difference in a time like this. Because you're seeing now, servicing values have shrunk, in some cases zero, some cases less than zero. But either way, they're not the multiples that they were. If they were 5 or 6x, maybe they're 1 or 2x, or in some of the Ginnie buckets, they're valuing them at zero, right? So in that case, if you are not a company, or you're not a company that has that ticket and have the ability to sell or service, you probably are not going to be competitive or even to get into some of these buckets. You won't be the one making the decision whether this bucket is available. Like the 620 loan, if you wanted to do it, it's really not up to you. At that point, you probably have to broker it, or you have to hope that one of the aggregators has a product and they've got a 300 basis point hit on it. So that's an advantage from that standpoint. It also gives you the ability to retain servicing at, a less price. I mean, you are going to take a risk, but servicing values are relatively low now, and you would imagine that the world will come back. And I always bet on the U.S. economy, and I bet on the U.S. housing market, obviously, that those servicing values will go back up. So for companies that are retaining servicing now going forward, I think they'll be in really good shape. Now, you are, of course, if you've been servicing for a long time, you're dealing with forbearance and those advances and those types of things. But fortunately, Ginnie has come up with a pretty good lending facility and a backstop. As we know, Fannie and Freddie, not quite as strong, but still some sort of backstop where you're limited to 4 months of advances. So I think it's a really good time for the independent mortgage bank to responsibly retain servicing.
So as we do watch the credit landscape tighten, I can't help but feel for those people at the low end of the credit threshold, first-time home buyers, people that don't have a ton of money to put down but are worthy enough to get in homes. Maybe they've got a 610 score. I mean, FHA was created in some way for so it can serve that segment of the population. So do you think that there'll be help on the way for that? At what point will that be looked at?
Yeah, so that's a great question. And what I'm going to give you now is obviously my opinion. And any number of people will have maybe a different opinion or a slightly different timeline of what they believe in this case. But again, if you go back to 2008, different set of circumstances. But what happened was one of the first things that stripped out of the market were lower score and FHA loans. Those just were the first things to leave. And here we're seeing that again. Difference is in 2008, we had a real problem with equity, right? That was the number one problem that was creating all this. So now I would expect a faster turnaround, because as soon as people go back to work, you would believe that since we don't have an equity problem, those products will come back a little faster than they did in 2008 and 2009. 2008 and 2009 took like 12 or 18 months. I think it'll be much, much faster this time around. And you asked, is it fair? No, it's not fair. You'd call it collateral damage, but it's also a reminder that, hey, it's really important to have a really good credit score. And it doesn't always matter in great markets when everything is great in the economy. But when things get tough, a really good credit score can really help you out.
So finally, David, give us kind of the state of the union for NFM Lending. You've obviously owned this company for over 2 decades now, going into your 23rd year. And I'm curious to know how you see the future for NFM and how well positioned you think NFM is to not only make it through this, but for many years to come.
Yeah. So first, let me just say that, in these kind of crazy times, I hope that all the companies that were healthy going into the pandemic will be healthy when they come out of the pandemic, in the short run and the long run. I don't wish ill will against any company in our industry. I think we need as many bodies as we can get, because we're in a really high demand refinance market that could go on for many years to come. And we probably can handle 2.7 to 3 trillion as an industry a year, and there's 10 trillion in loans that would probably qualify to be refinanced. So obviously we need all hands on deck. So where does that put NFM? Well, as you know, Greg, we were in a growth mode. We were prepared to double in size in 2020. And so we were hitting the runway going full speed when this pandemic hit. So in addition to all the other challenges, we had put a lot out there, and our volumes were becoming records, where our pipelines are bulging. So I feel great about when we get on the other side of this. We've got great systems, as far as I'm concerned, as good as people, probably the best people in the industry, from operations, admin, originators, branches, leadership. I mean, the company has just never been better. And I'm very bullish on the economy. I'm very bullish on the U.S. real estate market. I'm just, excited for us to get on the other side of this once we can get the illness to stop, people to stop dying, stop being spread. I think it's just going to be really great opportunity for NFM and companies like NFM.
Great insights and very upbeat. David Silverman, CEO and founder of NFM Lending. Thanks for spending some time with us here on NFM TV.
Thanks, Greg.
All right, we'll see you next time.